All right, I have 4 o'clock. I think we could get rolling. Yeah, thumbs up a little bit. All right. Good afternoon, everyone. Welcome to EQ Private Wealth Advisors and today's special program on the outlook for the remainder of 2023. I'm Peter Herman. We're in the middle of September, which is historically a difficult month for the stock market. And to paraphrase Mark Twain, October is also a particularly dangerous month to invest in stocks. So too is July, January, April, November, May, March, June, December, August, and February. The Federal Reserve has raised interest rates 11 times since March of 2022, as it battles inflation, which reached 9% last year, but has been trending down this year. Next week, we'll see if the Fed holds rates steady or if it feels the need for further tightening as it walks the tightrope, trying to balance full employment and price stability and pull off the proverbial soft landing. We're delighted to be joined today by Strider Erlas, who will share his thoughts and insights with us about what we may encounter ahead. Strider is a senior economist and part of the First Trust Economics team that Bloomberg has consistently ranked as one of the top forecasters of the U.S. economy over the past decade plus. Last year, Consensus Economics ranked the First Trust Economics team the most accurate forecaster of the United States in 2022. The First Trust Economics team also has won multiple gold medals from Financial Advisor IQ in both 2020 and 2021 for macro commentary and overall content. Welcome, Strider. The stage is yours.
Hey, thank you so much, Peter. It's wonderful to be with you and with everybody else. There's obviously a lot that's going on in the economy. And so let's kind of get right into that and talk about what's been going on. Today, in fact, we've got a couple different economic data that came out. We had retail sales, which grew 0.6% for the month of August. I mean, from the headline perspective, that looks like a massive increase overall, and it looks like the consumer's still strong. But the reality is that majority of that increase came from gasoline station sales, with the higher form of higher prices for gasoline at the pump. And so, yes, retail sales are growing, but the reality is that inflation is still taking a big bite out of what's going on for that consumer. And also, we got producer prices today as well, a measure of inflation, and that grew a lot stronger than what most expected. So all in all, when I look at the economy where we are today, I would say that we're still on pretty solid footing. We're not heading into a recession yet, but we do believe that you need to be cautious here moving forward, and I'll get into why. But when you think about really what we're dealing with today, I mean, it's been a crazy last couple of years, and I think it really goes back, everything that we're dealing with today goes back to that period of time back in really March and April of 2020, when we shut down the U.S. economy. I mean, we'd never seen anything like that before in history, and really 95% of U.S. population was on stay-at-home orders. I mean, unheard of. And it caused a very, very sharp, very, very steep recession that we went through over that period of time. But really, for me, I think what we're dealing with today are the policy ramifications of the policies that were put in place over that period of time. I mean, look at, for example, employment. We were adding jobs month in and month out. I mean, really at the we were in the longest recovery ever that we'd ever seen in history. Really, it started back here. Let me see if I can get a little pen going here. This is the longest recovery we'd ever seen in history. And we're averaging about 200,000 jobs per month being added every single month, month in and month out. And all that came to a close in March of 2020. When the shutdown started to take hold, we lost in that single month 1.4 million jobs. I mean, we'd never seen anything like that in a single month, but that's really nothing compared to what we experienced in April. And between March and April, we lost 21 million jobs. I mean, almost equivalent to all the jobs that we had gained in the longest recovery that we'd ever seen in history. You look at how skewed the data looks, how much smaller everything looks. Even you look back to the Great Recession that we all experienced and how tragic that was, how terrible that was. Well, that looks like nothing compared to this 2-month period, which was really self-inflicted through these shutdowns. The good news is that we finally added back more jobs here than we'd lost, But job growth is starting to slow. By no means is it negative, but it has slowed down somewhat. We think it will continue to slow into the remainder, through the remainder of this year and into next year, and in fact, start to turn negative next year. And really, I think a lot of what we're dealing with today, why have we not had this recession yet, even with the Federal Reserve, who's raised interest rates so dramatically over the last couple of years, from basically 0% up to 5.25%? Why have we not seen this recession when the Fed has become tight? I think a lot of it is due, again, to the policies and what was put in place back in 2020. You look at this chart here, this is excess savings. That blue line there, that's essentially how much on a monthly basis that households are saving. And if you drew that line out basically from the pre-pandemic trend, that's kind of where you'd be. The green that you see there, that's the excess savings that took place. And again, think back to that period of time in 2020, 2021. So many things were shut down. Even if you wanted to spend money, it was hard to spend money. And yet we added $5 trillion of stimulus to the system. And so all of a sudden, excess savings skyrocketed. In fact, it peaked at about 35% of incomes coming in were being saved in a few of those months that were coming in. And really, if you tally all the excess savings above what was normal, it came out to about $2.1 trillion. Well, recently we've been saving a lot less than normal. And so we've been tapping into that excess savings. And so far, we've tapped into about 1.9 trillion of that. So that excess savings is wearing out. In fact, I think over the next month or two, it will be completely gone. That to me is going to send more of a slowdown to the US economy starting here in the fourth quarter. But looking at the consumer today, I'd say the consumer is still in okay shape. Household debt is sitting at record highs. That's true. And many people are worried about that. But the reality is that just knowing the level of household debt doesn't tell us too much besides, yes, it's sitting at record highs. The reality is that you need to compare it to something else. And usually when households are taking out debt, they're taking out debt to purchase assets. And so a very effective measure to look at is household debt relative to household assets. And you can see really from 2000 moving on that debt relative to assets was growing and growing quite remarkably. And so I say that, yes, when we entered that housing crisis, the consumer was over-levered for sure. But you look at where we are today, although household debt is sitting at record highs, assets over the last 10 to 15 years here have been growing so much faster than overall household debt that debt relative to assets is sitting at some of the lowest levels really that we have seen in a very, very long period of time. But ultimately, for that consumer, what really matters for that household, what really matters is can they continue to afford to pay all of the monthly interest payments and all that debt that they have outstanding. And so what we like to look at is what's called the household financial obligations ratio. And basically, this looks at all of your monthly debt obligations as a share of after-tax income. So looks at your mortgage payments, student loans, credit cards, auto loans, personal loans, anything you have a monthly obligation to. This also includes in it, if you're renting, your rental payments, and it also includes property taxes. So pretty all-inclusive. And again, you can see 2000 moving on, household debt, or excuse me, the household financial obligations ratio was rising. In fact, it peaked at the highest level that we'd ever seen back to at least 1980. That's as far back as this measure goes, but peaked at record highs over that period of time. You look at where we are today, you really take out this COVID period, and we're sitting at some of the lowest levels that we have ever seen for this measure. But many worry, I mean, you think back to this period here, this is when interest rates started to rise, and you can see how that came up pretty significantly. Is that going to be the same case today with interest rates as dramatic as they've risen over the last year? Are we going to start to see household financial obligations go up substantially? I don't believe so. I think this time is very different from what we experienced back in 2006, 2007. And really, when you take a look at total debt outstanding for households, a majority of that is made up in mortgages. I know we hear stories about credit cards and student loans and auto loans and how those are sitting at record highs. And it seems like every couple of years we hear how credit cards are going to take us down, or student loans going to take us down, or auto loans are going to take us down. But the reality is that there's still a pretty small portion of overall debt outstanding. majority of it falls into this mortgage component. And so you can see how back in 2005, 2006, we got into trouble because if about 70% of debt outstanding is mortgages, and you think back to that period in 2006, about 40% of mortgages outstanding were adjustable rate mortgages. So you think about what happened over that period as interest rates started to rise, a lot of people bought these homes with very little money down. All of a sudden, interest rates started to rise and rates got adjusted higher and they could no longer afford these properties. They just decided to let them go. And we had this housing collapse. Now, is that going to happen again today? Because housing prices are at record highs. I mean, they've gone up substantially over the last couple of years. And at the same time, mortgages make up a big component and interest rates have gone up tremendously over the last year. So are we getting in the exact same situation? I think this time again is very different. For number one, as I said, about 40% of mortgages outstanding were adjustable rate mortgages back in 2006. Today, as of the first quarter of 2023, it's only 4.8% of mortgages outstanding that are adjustable rate mortgages. So we have 95.2% of mortgages outstanding that are fixed. But I think where it gets really interesting is when you start to look at, well, what are these interest rates actually fixed? What are these mortgages actually fixed at? And about 30% of those are fixed at 3% or less. Another 40% are fixed between 3 and 4%. So you have about 70% of mortgages outstanding that are fixed at 4% or lower right now. Now, if you try and get a 30-year fixed right now, it's about 7.25 to maybe 7.5. I mean, basically everybody in this category is under that. Especially in these two categories here, the chances of somebody being willing, if they're not forced to sell their home to buy an equivalent home right now, just to move, to all of a sudden assume a mortgage that's twice to maybe even 3 times as high as what they had before, just makes no sense. And so, although demand has fallen dramatically for housing, we have not seen inventories come onto the market because nobody wants to move. And so inventories are still very, very low across the United States. And so I'd say housing, supply and demand wise, is pretty much in balance right now. Very, very low supply and low demand. And so we're not seeing a massive drop in home values. And I don't believe that we will. Even though home prices have gone up substantially, we're not headed for another 2005, 2006, or really 2006 through 2011 with how home prices just collapsed over that period of time. But really, when I look at where we are today, and you think about the inflation that we've seen over the last couple of years, I mean, we just talked about housing inflation, how housing prices have risen dramatically. Really, it's prices across the board that have risen dramatically since COVID and really since the lockdowns took place. And I think most of it has to do with what the Federal Reserve decided to do over that period of time. They cut interest rates to zero. They provided liquidity to basically any sector that needed it. And lastly, they embarked on quantitative easing 4. Now, you think about what the Fed did over that period of time and really the stimulus that entered the system over that period of time, the $5 trillion that entered the monetary system. How did that take place? Well, it actually happened through the fiscal side, through government spending. And you look at this chart here, that blue line there, this is government spending. Doesn't really matter if you're a Democrat or Republican. This line just always seems to go higher and higher. And then you see this hockey stick higher that took place in 2020. And really, you think about, how did government spend trillions of extra dollars? Because the only way government can spend money is by either really borrowing it or taxing it. And usually they do that through the private sector. But back in 2020, something different happened. Instead of the government borrowing it from the private sector, they decided to borrow it from the Federal Reserve. And so the Federal Reserve created trillions of dollars of new money out of thin air. And with that, they purchased bonds from the Treasury Department. And so now the Federal Reserve has all of these bonds and the Treasury has all of this cash. And the Treasury took all of that cash and they directly deposited it into people's bank accounts. So now all of a sudden, people's bank accounts are filled with all of this money that was created out of thin air. And so when you take a look at what occurred over this period of time, we saw the money supply, that's money that's outstanding in the United States, it skyrocketed. In fact, it grew by over 40% in a 2-year period. The reason that we saw inflation in the United States was it's simply just all inflation is too much money chasing too few goods. If you grow the money supply by 40%, so if you grow money outstanding in the economy by 40%, but you don't grow production of goods and services by about 40%, you're going to have more money per good or service. And that's exactly what we have seen. And the reason that we have seen this massive inflation over the last couple of years. Now, the question is going forward here, is inflation going to continue to come down at the rapid rate that we've been seeing, or is it going to start to go back up, or are we going to finally get back to stable pricing, back to around 2% growth a year? And when you think about what the Fed said over the last really couple of years, so much of their blame has nothing to do with anything that they've done. It has everything to do with all of these one-off events. It's been due to the pandemic. It's been due to the war in Ukraine, climate change, drought, supply chain issues. I mean, the list goes on and on, the excuses that they've used. But the reality is that what's really driving the inflation higher has been money supply growth. And it's interesting to me because we seem to live and die by every word that Chairman Powell says about where things are going. But the reality is that they've been so off on their forecasting. It's almost laughable if it wasn't said. You look back at their December 2020 meeting, and in that meeting, they expected inflation was going to be by the end of 2021 about 1.8%. And actually, in that meeting, they said, if anything, we think the risk is to the downside. Well, you look at what's happened over as the year went on, as we started to enter 2021, and you look at their meetings as they came out, they started to continue to raise their forecast. This meeting here was in June, the blue dot there. And in that meeting, that's when they started to use the word transitory. They said, yes, we're seeing high inflation right now, but you don't need to worry about it. It's what we call transitory inflation. It's going to go away here in a couple of months. In their September meeting, they raised over 4%. And they came out again saying, look, this is all transitory. We're not worried about it. And even look, by December, they only had to forecast here for 3 weeks. They came in at 5.2% for the end of the year. We actually came in about 5.8%, a lot different here than the original 1.8%. And this is when Chairman Powell came out and said, look, it looks like inflation's a little bit more ingrained than we originally thought. So we're going to drop that transitory language and we're going to have to be a little bit more aggressive in 2022 here. Instead of us raising interest rates one time for 0.25% or 25 basis points, we're going to have to raise rates 3 times for 75 basis points. And again, you look at their forecast for inflation, they were expecting that by the end of the year of 2022, inflation was going to be running around 2.6%. Well, finally, by March of 2022, they got the picture. They raised their forecast dramatically for the end of the year, and then they continued through the rest of the year as inflation continued to rage. And instead of raising rates 3 times for 75 basis points, they did the equivalent of 17 25 basis point hikes for 425 basis points, or 4.25%. I mean, we'd never seen anything like that. And so you look at their forecast right now for where we are going to be at the end of 2023. Is that reasonable? I think it's more reasonable than not this time around. But the reality is it's not to do with all these external factors that the Fed thinks are what's been causing inflation or making it go away. It has everything to do with, again, the money supply. That's what you want to be focused on. And what we saw here, again, there's that 40% increase in M2 money supply. But over the last year or so, money supply has actually been contracting. Very rarely does money supply contract. Really, the last time we saw it contract at least this pace was back during the Great Depression. And the reason that we didn't just see a recession back then, but a depression, was because the Fed cut money supply over that period of time by 1/3. It was a massive mistake. So are we heading for a depression? No. The Fed back then, we did not see a 40% increase before we saw the Fed start to actually see money supply contract. This time's different. We saw this massive increase here, and now we're seeing a contraction. So what this tells us is, yes, inflation is slowing and will continue to slow due to the fact that M2 money supply is continuing to contract year over year. But with that, we think it's also going to lead to a slowdown in the economy coming probably sometime starting in the fourth quarter or in the first quarter, which is going to lead to a mild recession in the United States. So that brings up the point. Well, should I be, running to cash here, selling everything and moving to cash? No, I don't think so at all. Number one, we could be wrong. Maybe we do have this soft landing and maybe everything works out and we don't have a recession and the market just continues to march higher. That's a possibility. We don't see it as likely, but it is a possibility. But number two, I think you should always be in the market. That's the beauty of having a financial advisor, because everybody's different where they are in life. Maybe you're in retirement, you no longer need to be in the market. You can be in all fixed income right now. Everybody's situation is very different. But if you have a 10 to 20 year outlook here, I think there's no better place to be than in the market. And right now, I'd say in the short term, yes, we are concerned that we're headed for a slowdown and a recession, but that's not to say that companies still can't do well in that environment. And what I'd be overweighting right now is you want to be in those companies that have very quality balance sheets, that actually have earnings, that have cash assets. You want to just be more conservative in this environment. You don't want to be chasing those high growth names right now that have performed very well this year. I think they're going to get hit and hit pretty hard here in the coming year as valuations come back more to reality. But it's not a reason to move out of the market. In fact, when I look over the next 5 to 10 years, I think some of the best years that we have seen in the market are just right around the corner. What we're dealing with today has nothing to do with that. It's not that the United States is broken. The reality is that we just have payback coming for the ramification from those policy decisions that were made back in 2020. And if you take a look here, I mean, you think about what really drives growth over time. It's that entrepreneur, it's corporate profits, it's how well companies have been doing. And you think about the innovations that have come online in the last 10, 20 years. I mean, it's been pretty amazing. The cloud, smartphones, tablets, 3D printing, hydraulic fracturing and horizontal drilling, which has revolutionized the energy industry, nanotechnology, biotechnology, artificial intelligence. I mean, these are the things that are driving growth despite all the headwinds that we've been facing. And for me, think about that smartphone. It's the most amazing technology that's ever been created because it allows us to consume information like never before in history. Maasai warriors in the most remote part of Africa, most of them have access to smartphones now. That means that a Maasai warrior has more information available to him through that smartphone than the president of the United States did just 20 years ago. And yet the average Apple user swipes open their phone 80 times a day. So let's just say 40 of those times they're looking at media. You're not hearing about the 99 homes that didn't burn down. You're hearing about that one home that did. And you hear about it over and over and over again. And so I think it gives us a little bit of a perverse view of this world. It makes it feel like things today are worse than they've ever been in history. And yet the reality is, as you look at this chart right here, that things just continue to grow, get better. This is living standards in the United States. Not all the time, but over time, things continue to get better. Why don't you think about this for a second? This is about 170 years of history here. Think of all the terrible things that happened over this period of time. We fought in 9 major wars where we lost 1.3 million Americans fighting in those wars. Stocks fell from a recent high by at least 10%, 102 different times. Lost a third of their value 13 different times. And here we sit not too far from record highs. 4 U.S. presidents were assassinated. When you think back to 1918, 675,000 people, right around here, 675,000 people died in a single year from the flu. Our population was about a third of the size that it is today. That was just in the United States. What I find most amazing over this period of time is we had 34 recessions, which lasted a cumulative 48 years. So almost 1/3 of this time, we're sitting in recession. And yet living standards over this period of time increased 20-fold. 20-fold. Being optimistic doesn't mean bad things aren't going to happen. We open the newspaper, and that's all we read about. But I would argue that there's so much more good going on today than there is bad. And that negative section almost every year gets a little bit smaller, while that good section gets a little bit bigger. But I think especially with the advent of the smartphone, the amount of information we read about that much smaller negative section has grown almost exponentially, that we miss out on so much of the good that's going on all around us. And so I think today more than ever, perspective really matters. And when you look at the way that our country is built here in the United States with private property rights, rule of law and a functioning democracy. I mean, those three things in place make this a breeding ground for the entrepreneur. It's not always easy, and I think this is going to be a tough year, the rest of it and into next year. And yet still that entrepreneur is alive and well. When you look at what we hear about artificial intelligence, I mean, it's incredible. That technology isn't new, but it's just continuing to get better and better as chips get faster and faster and cheaper and cheaper. Big, large companies, Apple, Google, Microsoft, Netflix, Amazon, they've been using artificial intelligence for years and years. And I think a big reason why they've been able to grow and be as profitable as they are is because they've used technologies that have made them so much more productive. Well, now that technology is starting to come to small and medium-sized businesses. And when I look out over the next 5 to 10 years, I think the productivity gains that we are going to see are going to be immense across the board. And with that, the returns that we're going to experience in the market as well. And so, yes, in the short term, I'd say protect yourselves. You want to be more conservative, overweight value in high quality companies. Find those companies that are paying strong dividends. But over the next 5 to 10 years, get ready, position yourself, because I think we're in for some pretty strong returns moving forward here. Thank you all. Really pleasure to be with you, and happy if there's some questions here, happy to take any questions, but I'll kind of end there. I don't want to go too long for you guys, so appreciate you.
Strider, thank you so much for the insight that you gave us today. For the sake of time, if it's okay with everyone, I'm going to ask a few questions that have come into our queue here. So one question that comes up frequently, Strider, is with clients and colleagues, is the role of US dollar as the world's reserve currency. I know there's been a lot of coverage about this topic as of recent as well too. We'd like to know your thoughts about the dominance of the US dollar as the world's reserve currency and if its current valuation with respect to other currencies. What are your thoughts on the US dollar in general?
Sure. Yeah, it seems like every couple of years this comes up that the U.S. is going to lose their reserve currency status to either some other country or a block of countries. Usually China's involved in that, and maybe at some point it will happen, but I doubt it will be any other country. I think it will be a new currency if ever the dollar gets replaced. Really, the only way the dollar will lose its status as reserve currency is if the United States moves more and more towards socialism and starts to adopt a lot of policies that have ruined other countries. I think that there's a small chance of that happening, but there's always a chance. The reality is that the dollar still makes up about 90% of transactions across the world and majority of trade. And even if the dollar today was people no longer wanted to use the dollar as a world's reserve currency, it would take years and years for that to be able to unwind around the world. And I'd say when I take a look at where things are today, and you look at the rest of the world, anytime there's some tragedy or something that happens where there's a flight to safety, the world continues to flock to the dollar. In fact, if you look at the dollar against other currencies right now, it is very strong. And so this topic that continues to come up with Russia, China, maybe Brazil, starting using the yuan or some other currency that they're going to come up with that's going to be the new world reserve currency, I almost find laughable, because if you look at the top two countries that millionaires and billionaires are fleeing right now, number one is Russia and number two is China. The United States is actually seeing a net inflow of millionaires and billionaires into it, not an outflow. And the United States is one of the only countries in the world where people fight to come into the United States to live. That in itself tells you why the U.S. currency is the world's reserve currency. And until that changes, we're not going to see any change there.
Well, I'm glad you actually mentioned those countries, because we've been having, look, in the last 40, 50 years, America was untouched as a world power. And now that is being challenged by China. So we get a lot of questions about, hey, is China going to take over U.S.? Should we worry about China? And I know China was on a very nice trajectory right before COVID in terms of economic growth. And as of latest, there's been some news coming out with some softening and, a contraction in their economies. But ultimately, they're forced to be reckoned with. Like, should investors be worried about China?
Yeah, I would say no. And I think for a couple of reasons. Number one, China's been around a lot longer than the United States. I mean, they did nothing for 2,000 years. And then really they started to explode over the last 40 years. And so why did China start to really explode over the last 40 years? Well, they started to adopt capitalism. And because they started to adopt more free market policies, they were able to grow and expand. But you think about what they skipped over that period, that 2,000 years. I mean, you think about the United States, every technology we've basically created and then built up. So we went from, you think about phones, we had to go build out copper lines across the United States and so on and so forth, and then cell towers and whatnot when cell phones. Well, China basically skipped all of that, just went straight to cell phones. The infrastructure, they were able to create the best and newest infrastructure. Well, so think about all the productivity gains that they saw in a very short period of time because they're able to borrow or steal technology from other places. Well, now they're basically on equal footing, I'd say, with the United States in terms of technology. And so they can't go out and see massive productivity gains anymore because they're on equal footing. They've used all that other technology that's already there. And so moving forward here, I think what really matters is what the United States is based on: rule of law, private property rights, and a functioning democracy. When I look at China, yes, they have capitalist policies to some degree, but they're still communist. And when you look at they have a 5-year plan. And the reason that China is in so much trouble right now, whether you look at manufacturing or whether you look at especially real estate, is because that 5-year plan was malinvestment. They believe, a small group of people believe that they're smarter than the entire market in terms of where to allocate resources. And so they allocated billions and even trillions of dollars into housing that wasn't needed. And now all of a sudden, the real estate market's in real trouble there. And so, number one, I have a hard time believing data that comes out of China, period, the economic data. But in terms of it having a massive impact on the United States, we are such a big importer from China. We're not that big of an exporter to China. So when China slows down, it doesn't really hurt us that dramatically. The opposite is not true. If the United States slows down because we import so much from China, it hurts China dramatically. And so as long as it's going the opposite way, where China's the one slowing, not the United States, we shouldn't have too much of an impact from that slowdown. And in fact, a lot of manufacturing companies are now moving out of China to other Southeast Asian countries or even to the United States. So I think that the decoupling from China is going to take a long time. But I do believe it's probably needed, but it is going to lead probably to some higher prices. So I think the real thing that we'll see from China is really companies leaving China, which is going to cause slightly higher prices for goods and services for a while.
Wow, thanks for the insight. Lastly, I know we're at the bottom of the hour and we promised 30 minutes, but one last question, if that's okay,
Sure.
is the debt that we have, the national debt. I mean, obviously we have $33 trillion worth of debt. We have to pay interest on this debt. And what are your thoughts about what's the best way for us to get at it? Is there an end in sight? I know they asked Warren Buffett this question. He said, I can end it in 5 minutes by just making sure all the elected officials that are running for Congress are ineligible if they're not balancing the budget. But
Sure.
What's the end in sight in here with the debt that we have?
Yeah, that's a great question. And it's a tough one too, because I don't think there is an end in sight. As of right now, I think over the next 5 years, things look okay. Even though we have $33 trillion in debt, the interest rate that we took out, majority of that debt out was very, very low. And so if you look at, compare, it's always important because all these numbers are so big, it's important to compare it to something else. And so one way to look at it, whether you want to look at it as net interest payments as a share of revenue or net interest payments. I like to look at net interest payments as a share of our economy or as a share of GDP. Right now, they're about a little over 2% right now, which has gone up significantly over the last year just because of higher interest rates. And as more of that debt rolls over and we have to reissue it, it's going to be at higher interest rates too. But probably in the next couple of years, we're going to get up to about 3% of GDP or 3% of the economy in interest payments. Now, a lot of people are worried about that, but if you look back to the 80s and 90s, that's about what we averaged, was about 3% of GDP for interest payments, because interest rates were so much higher back then, even though we had a lot lower debt. The real issue is, the next 10 to 20 years. If we continue to spend at the rate that we're spending at and continue to accumulate, $1 trillion, $2 trillion deficits on an annual basis, that is going to be a very big issue in the next, 10 to 20 years. So the way to fix this is really, I would say simple. And it is, you have to cut government spending. Now, that's easier said than done, because nobody wants to cut government spending. And when you look at government spending, majority of government spending, more than 70% of government spending, is just transfer payments to individuals. So Medicare, Social Security, Medicaid, payments out to individuals. That's what really needs to be fixed. And so I don't know what they're going to do, but I think probably this next election, they probably won't focus on it, but I think the following election will have to have a major focus on how do we get things back into order. And the reality is I think it's going to be broken promises to, maybe younger generations for Social Security, or they're going to have to cut back in some ways. I am optimistic too, when you look at, what's going on with artificial intelligence and how drastically that's probably going to change healthcare. In a beneficial way of allowing people to know ahead of time, whether there's a good chance they have cancer or whatnot, so on and so forth, sickness in general. I think it's going to lower a lot of the costs that we're currently seeing for the healthcare system. And so that in itself, I think, will provide a meaningful break in terms of the growth that we're seeing across the board for government spending in healthcare related areas. But all in all, you have to cut government spending. Taxes are not the answer. Raising taxes are not the answer. If you look right now, you look back to 1950, on average, government spending since 1950 has averaged about 19.5%, while revenues have averaged about 17.5% of GDP. Right now, government spending is averaging about 26% of GDP, and revenues right now are averaging about 17% of GDP. So it's not a revenue issue. We're getting about what's normal. It's a spending issue, and that's what really needs to be fixed.
Well, thank you for that. Do you have maybe 1 minute, if I can ask you one question that just came in? 1 minute.
Sure.
I know. What would be the economic or long-term effects of the U.S., sending tons of money overseas with the war that's going on between Ukraine and Russia?
Yeah, I mean, in terms of long-term effects, I don't know. I don't think there'd be any long-term effects besides it's an extra $100 billion or so that's being spent overseas that's not being spent in the U.S. for productive uses. Whether you agree with it or not, that money being spent or being sent over to Ukraine, I would say that it's not, in terms of from an economic perspective, it's money that is not being used to the best of its capabilities, especially in the United States. So what that leads to is higher debt, higher deficits in the United States, and slower economic growth. And so if it's not something that's growing productivity substantially in the United States, it's a net negative in general. Is it something that would pull us into recession or even cause a massive slowdown? No, 100 billion in the grand scheme of things is not too significant. But then again, 100 billion is a lot of money that could be used for other uses here, just domestically in the United States. So net, I'd say it's not a positive, but is it something that's going to ruin the economy? No, but taxpayers will eventually be on the hook for that money.
Right. Well, listen, thank you so much for your time and, your insight that you gave us today. Thank you, everybody who attended this, presentation. I know it was a little bit of a short notice and we had some communication issues as well too, but truly appreciate your time, Strider, here. And we look forward to probably having you on board pretty soon again, if that's okay.
Oh, sure. Would love to. Thank you all.
All right.
Great
Thank you, everybody. Have a great day. Have a great evening. Bye-bye.